All right, thank you for the introduction. We are process-driven value investors. And when it comes to value investing, process is the key. And we're always looking to learn from people who have some great processes. And in most of my conversation with market participants, one name always comes up, and that was Pankaj. So when JC said, you have to moderate Pankaj's session, I said, without a problem, absolute pleasure, right? So let me just introduce Pankaj and his career path. Pankaj brings over 2 decades of extensive fund management experience. He started with Kotak Mutual Fund, where he successfully managed assets worth 56,000 crores. And that's over a remarkable span of around 14, 15 years, right? So he significantly grew the Kotak Emerging Equity Fund from 113 crores to 36,000 crores. Whooping. Now, by the way, that became the country's second largest mid-cap fund by the time he did that, right? So now, additionally, he expanded the Kotak Small Cap Fund from 127 crores to 13,000 crores, ranking it the 5th largest fund in that category. Now, under his leadership, the Kotak Mutual Funds have reached the AUM of 3.5 lakh crores as of November 23, positioning it among the top 5 Indian AMCs. He also managed the Kotak Business Cycle Fund and the equity portion of Kotak Equity Hybrid Fund. So Pankaj has been consistently recognized among the top 10 fund managers in India by Outlook Business and is featured as the top fund manager by Economic Times and Morningstar. So eager to learn the processes of Pankaj, and let's make it a great learning session. Welcome, Pankaj.
Good afternoon. Itna thanda. Good afternoon. Good afternoon. That's it. What we'll do is that over the course of next 40 to 45 minutes, I'll make sure that whatever I have little bit learned over the last 2 decades, I share with you. And whatever I'm going to speak is what we practice every day. And it's part of the process which probably has helped us survive cycles. The reason I want that this session should be carefully listened is that, as Sunil Bhai said today, in the market we are right now, the probability of making mistakes is extremely high. And when I go around, different social circles, different people I meet, education colleges, the kind of, enthusiasm people are having for equity markets, the return expectations, I think that's all is fine, but if you don't have a process, and if you don't have the softer aspects which probably are needed to survive in these equity markets, probably you will make mistakes. And once you make a large mistake, markets are not charitable. So what I'll talk about is something which could anchor you at every cycle and help you survive it. And in this market, what not to do, as Rajesh was mentioning, is extremely important than what to do. So let's start it. Just a minute. Yeah. So I think the 3 things which is the core from our perspective and what I have learned is MVV, which is management, business, and valuation. And friends, the segment which I operate in is the broader market segment, which is apart from the top 100 companies, which are well discovered, the next 300, 400, 500 companies of India, where you can make a significant impact if you do some deep research. And I think the first most important coordinate there is the management. I think time and again it's been proved, and when I reflect back on my last 22 years, friends, one thing common which I found across all my success stories is that there was a management team, a promoter, which was passionate, honest, uski niyat sahi thi, and over a period of time, no company is in a growth phase forever. There are cycles, but during that bad phase, the management made a difference. It's a subjective term that everybody thinks management is good. On the hindsight, we come to know which management is good, which is not. But can we bring some art and science to it? And I'll talk about it. So this is the 4 charts. Kuntal bhai, your favorite leadership thought process. But this are the 7 pillars where we think that, we judge the management on. Trust, culture, integrity, scalability, capital allocation, delegation, and focus. And over a period of time, if you can get these 7 pillars in a way, in order right, I think probably you will not make too many mistakes in your stock selection. Easier said than done. How do you do that? I think, one, a lot of people look into the future forecast. I think when you are evaluating a management, it's very important to look into the past. And friends, trust me, tigers don't change their stripes. Agar kisi ki niyat kharab hai, it will show up over a period of time in his conduct. And what you need to do, what we do, that before meeting the management and any new ideas, probably we try to make sure that we do a cross-check. By virtue of a network, now I have a network of about 71 chartered accountants across the country. And trust me not, these chartered accountants give you a lot of insights into the promoter. They may be the financial influences of that city, but what is there the promoter is doing in the morning, at night, his personal balance sheet versus company balance sheet, and in terms of speaking to the entire ecosystem. And there also over a period of time, we have brought in a lot of tech tools which are readily available if you want to use it. For example, LinkedIn is a great tool. A lot of people think it's a social media tool. Let me give you a small example. We were investors for about almost 6% of a company, decent sized company, well-known company. And we came to know that there was a lot of attrition happening at the middle and the senior level management. We spoke to the promoter. Promoter ne bola kuch bhi nahi hai aisa. But I was not fully convinced. We went back. We just used LinkedIn, X, that company name, and about 13 people who left in last 6 months, their names appeared. Because everybody likes to update their LinkedIn profile the moment they leave the organization. We were able to speak to 5 and 6 of them, and we came to know the real problem, what was there. And we went to the management. He was shocked. Where did we get these names from? It was so readily available. And then he accepted, yes, this guy came in, they couldn't adjust to the culture, few people left. But the most important pillar, which was trust, was kind of shortchanged. And over the course of next 8 to 9 months, we exited the stock completely. That for a small attrition, if the management can lie, there could be many other instances, bad news, where the management will never say you the truth. But how did you do that? LinkedIn. And trust me, friends, it's a great tool. If you use it rightly, you can get in connect with the suppliers, vendors, ex-employees, current employees, and can form a 360-degree view about the culture. The second most important is, I don't know how many of you have used Glassdoor. There could be disgruntled employees also there, but you can come to know what the employees are talking about the culture of the organization. And it's very, very handy, trust me, if you use it rightly. Obviously, you have to filter it between what is right, what is not right, and match up with the attrition, which gets reported in the annual report every year. The other important part is that how do you kind of do that for other tools, Toffler, Zoba. I'll give you a small example. We were investors, we were evaluating one company, and through Toffler and Zoba, when we looked at the board of directors, it creates an entire web. We came to know that one of the directors was the director in 2 of the bankrupt or the papi companies, so-called. And we were wondering why this promoter has kept this as a board of directors. And after a 3-4 year period, we figured out that there was some issue relating to signing off some of the audit accounts and stuff like that, and the fraud was discovered. Also, what a lot of people do, that they try to look out for companies which have been successful. Friends, if you invert the situation and build it as a part of the process, the reasons for which the companies have got, there was a fraud or bankruptcy or wealth destruction, I think you can make your process foolproof. We did that for the last 30 years for the wealth destroyers, not for wealth creators. And what were the common reasons? Balance sheet, cash flows being weak, promoters siphoning off capital from the balance sheet and company, succession planning, feud, tech disruption. And one more thing which we found, which is not written in the textbooks, but probably was very important for the Indian context, that whichever company did fraud, you will laugh on it, but it's a fact, that the promoter never kept the lady family member as part of the board. Because we Indians are very protective about the lady of the house, and the moment promoter himself first knows, is there a fraud going on, and he keeps the family, especially the lady of family member, whether it's mother, sister, daughter, wife, separately. There could be genuine reasons for not doing that because of various, mischaps happening in the plant and board of directors being liable for it. But generally a common theme which we found was that wherever the fraud happened, wealth destruction happened, the promoter never kept the lady family member as a part of the board. How did we build it as a part of the process? So whenever we, in any company, we see that there is a wife, lady, anybody a part of the board, I think it gives us a lot of comfort. It's not that everything is hunky-dory there, but a checklist, yes. And I think that's a part of the process which we have built it and make sure that we make less and less mistakes. Also, there are various things which you can do. For example, before you come to know, for every company you invest, just put a Google alert on any of the things. Now with AI, and I request Kuntal Bhai to talk about it, he's doing a lot of work on that when his session is there, that how can you see what are the cases going on against the promoter in the past. Normally, you won't be able to do it, but AI will help you decode so many documents across, right from criminal, civil, and everything, and try and figure out. Unless you have a handle on whether we are betting on the right management, right promoters, right team, I think, trust me, friends, you will always be swayed by the price of the stock rather than having a conviction on the company. The next is the business, and I think business is extremely important on what are the important things from a business perspective. I think it's more and more becoming challenging because there's so much of disruption happening across the globe, that what is the terminal value which you give to the business. And many businesses which were growth oriented, say a decade back, have now become value, and value companies have become growth. So how do you navigate that challenge? And I think it's very, very important that you have a TAM overall on the business side. What is it a small fish in a large pond or a large fish in a small pond? And I think once you start evaluating which businesses can generate superior return on capital, the capital which they can reinvest back into the business at higher growth rates, and the cash flow side, trust me, friends, you have got a cash flow machine over a period along with growth. And I would repeat again that growth is important, but not at any cost. We have seen time and again companies which deliver growth but without cash flows and return on capital are recipe of disaster. I'll give you small examples. There's a company A which generates about 25% return on capital, but growth grows at about 10 to 12%. The question is, does the company need to improve that return on capital from 25 to 30%? Or does the growth, if it moves from 12 to 15 or 20%, will add more value? Which one will add more value, friends? Growth. Because the hygiene of return on capital is much, much higher than your weighted cost of equity at 25%. So every incremental growth will give extra value to all the stakeholders. Company B, 8% return on capital, growing at 20%. Will growth add more value, or will improvement in return on capital add more value? Yes. Because you are operating at a much lower return on capital, and if you try to grow at 20%, the gap, either you have to fund it with debt or equity and keep leveraging your balance sheet over a period of time. And that's a recipe of disaster. Very few managements, very few companies in India understand that. And that's why over the last 20, 30 years, the number of companies which have destroyed wealth are far more than the companies which have created wealth. And the reason is every company wants to grow, but nobody wants to grow in the right way, along with cash flows and better return on capital. And that's why in the last cycle you saw so many companies with return on capital being much lower, infra companies, real estate companies today are penny stocks. It doesn't happen tomorrow, it doesn't happen day after tomorrow, but over a cycle of 3-5 years, finally it's back to basics of investing. And I think it's very, very important right now, because so many narratives, so many stories are floating around that I get a bit scared. Many companies between 25 to 35,000 crore market cap today, friends. Lot of narratives, lot of stories. But when you look at the operating cash flow 5 years added, they have not even made 5 crores of operating cash flow. Forget about free cash, right? And we are giving them all on narratives, sales, stories, and P&L. Finally, the truth will prevail. And if they don't generate operating cash flow, one bad cycle where they will not get debt, they will not get equity, they will burst. And I think it's very, very important to understand that part once you are evaluating business, that does it can generate return on capital, cash flows along with growth. Only growth without these two are recipe of disasters. I'll quickly move on, just a minute. This is something we have been doing for screening. It's not a foolproof thing, but generally it gives us a good indication that what is the return on capital on a 5-7 year basis, 16-18%. What's the PAT growth and EBITDA growth? And look at the last one, the operating cash flow, which I will touch upon in my forensic part. If any company, EBITDA post-tax converts at less than 70% to operating cash flow, I think it's a red flag for us. I'm not saying for 1 year, 2 year, but 5 years, 7 years in a row, if they are not able to convert the EBITDA post-tax into operating cash flow, post-working capital, more than 70%, there's something wrong. Quickly, I'll move on to the price which is there, but let me look on to a very important, pertinent point for all of you is the forensic. I think what not to do is so important in life. And the book, if I want to know where I'm going to die, I'll never go there. It's an apt book. I don't know how many of you have read it, but it's one of my favorites. And over a period of time, you should have a framework. This framework helps us decode companies with accounting issues, governance issues, and over a period of time, if you make less mistakes, you can stand on the pitch for a long period of time. You don't have to hit every ball out of the park, friends. What you need to do is assess the pitch. Few overs need to go maiden, let it go, but make sure you don't make big mistakes. And how can you do that? This forensic framework helps us decode some of those things. So for example, the first part I spoke about cash flows. If the operating profit to conversion to cash flow is not greater than 70% over a cycle, it's something which is an alarm. you should be careful about it. Look at this part, the change in reserves. This part, right? I won't name the companies, but there are many companies in India where profit minus dividend should add up to your net worth. Haan ya na? And net worth is what? Shareholders fund, book value, whichever name you can give it at. I'm sorry to say, many companies in India, profit minus dividend doesn't flow to the net worth. आप लोग सोच रहे होंगे कहाँ जाता पैसा? And 5 साल EPS is growing, but net worth doesn't move, which is your book value, which is the shareholders fund you need. And when you look in detail, a lot of write-offs, which needs to be done through P&L, happens through balance sheet. These are the things, friends, market get excited by EPS growth, but very rarely do people find out that after dividend payout, does that amount add up to your net worth or not? Look at the CAGR in auditor remuneration, the last point. Many companies we see which have been well destroyers, they have incentivized auditors through audit fee, non-audit fee. In one of the companies we saw that the company was paying 1.5 crores to the auditor. And similar size company in the same sector and other sectors, the NAFLA amount was about 20 to 25 lakhs. Immediately alarm bell, why is this company paying so much? After 5 years, 4 years, we figured out there was a fraud. And the auditor was incentivized to pay more. How do you figure out when you're assessing? Few things like this, and then obviously CWIP to gross block, that what it is there, cash yield, very, very important point. Companies show a lot of cash balances at the end of the year, at the end of half year, and we kind of doing the calculation give that benefit that cash is real. But friends, many a times we have seen that cash yield tells us the right picture. In many companies we saw, the cash yield was just 1.5%, 2%. Now you tell me, is the treasury bad or is there no cash? So over a period of time, you come to know that this cash balance was kept just during the quarter end or half year end to show to the markets that there is cash, but there was no cash. Otherwise, which promoter in India will generate returns in the cash on the balance sheet below your repo rate or treasury rate? Not possible. And this is how we have avoided some of the big names which had problems. You know which companies I'm talking about in 2008, one IT company, one travel company, one housing finance company, and so on and so forth. They used to show a lot of cash, current account, savings account, but the cash yield was not commensurate with that balance which you used to calculate. So few of these things will help you decode the company into 3 brackets: zone of safety, zone of pain, and zone of darkness. Avoid zone of darkness, friends, over a period of time, and you will be fine in the markets across cycles. But trust me, right now in the last 2.5, 3 years, which segment of the market has outperformed massively? It's not zone of safety, zone of pain, it's zone of darkness. So be very, very clear and category about that you should not be making the same mistakes right now. आज नहीं पता चलेगा, ये mistakes आपको 3 साल बाद haunt करेंगे, because bull markets में ही गलतियां होती है, bear markets में गलतियां नहीं होती है. Then I think the most talked about thing which help you survive is portfolio construction, friends. Over the last 2 decades, one thing which I have learned is that the entire market focuses on stock picking, stock picking, stock picking. But what is most important in making money over longer periods of time and compounding it is not only stock selection, it's portfolio construction also. Think about the market like last few days. If you were in just few stocks, high beta stocks that corrected by 40 to 50% in a matter of less than a month, and your portfolio is down by say 15, 20%, it will take a long time for you to come back from where you started. गिरना लाइफ में आसान है, गिर के उस लेवल पर वापस आना बहुत मुश्किल है. So, if you focus on portfolio construction, which means sector weighting, sizing, and diversification a bit, I think over a period of time, it will work. And at least for me, I'm not saying there is only one way to do things in life. Markets is a place where there are many paths to riches, but very few to failure. So if you know that which paths, it's upon you, your personality, your temperament, but certain things which probably will lead to failure. On stock picking I have spoken about, but focus on construction also of portfolio. What kind of a sizing will you be comfortable with? What kind of a names you will be comfortable with? I'll give you small examples. Many, many years back, I had 28%, I still remember, allocation to all the Chennai-based companies. Great companies, good companies, but one tsunami happened, and I never focused on geographical diversification. And in a month, the portfolio had a huge, huge impact because all the companies, because of tsunami for 1.5, 2 months, were impacted on that. That let me understood what it is. And second is also, finally, as public portfolio managers, we also need to be concerned about the benchmark. I think very few people give credence, and as active managers, ले लो, देखेंगे benchmark क्या है. But during bad times, very few people are able to outperform it. And that's because you have not given a thought to the active share. People run portfolios with 80, 90, 95% active share. During good times, they are becoming heroes. But one bad cycle, the gap between men versus boys is clearly shown. So that's all about portfolio construction, that what could be the market cap, weightages in your portfolio, sector breakdown, portfolio sizing, which kind of geographical diversification, sectoral diversification. I think, am I 100% there over the last 20 years? Answer is no. But are we 60, 70% there, understanding the portfolio construction as an important tool for generating alpha? Answer is yes. And trust me, सब लोग बोलते हैं मुझे ये पता था ये स्टॉक ये है ये है ये है. ट्रस्ट में जब आप लेते हो ना, किसी को इस रूम में नहीं पता है कि ये स्टॉक मल्टीबैगर होने वाला है कि नहीं हो रहा. अगर पता होता तो आप सब कुछ बेच बाच के उसको उस स्टॉक पर लगा देते हैं, बट नहीं होता है. ये रियलिटी में, लाइफ में नहीं होता है. It's over a period of time when the companies execute, your conviction gets higher and higher. And that's where your sizing makes a very important difference. At any point of time, however I convinced, or my team will be convinced with, we'll never start any position with 5% weight straight away. We'll start with 2.5% at max, and then scale it up as the company executes, as we get more and more trust over a period of time. So this is our approach, gorilla to King Kong, through stock selection. Have multiple gorillas selected. I don't run a very concentrated position. That may not be the style for many. I'm saying paths to riches are many, failures are few. So you can choose your path, which is more suitable for your temperament. But at least I get worried that I should not make any big mistake which dilute my good work and returns over the past. And I should have a peaceful sleep every night. And I think that gorilla to King Kong diversification gives me that ability to do that. This is something over a period I have tried to figure out, that what are the traits. Normally, we have seen that companies which have grown their profits about 20 to 25% CAGR over the 4-5 year period tend to become multi-baggers, 10x in 10 years. Capital allocation, which I spoke about, return on capital has to be higher. I have not seen many companies, except the new age companies which are making news headlines. I have not come across many companies which return on capital has been inferior and they have become multi-baggers. Size, normally we have seen the size of the business, market caps are small when they become large. But friends, let me give you a caveat. The mortality rate is extremely high. only 11% of mid and small cap companies over the last 25 years have been able to become large caps or mega caps. 89% have either seen mortality or stayed where they are, either mid or small, or became micro or penny. So be very careful when in this market, everybody talks about multibagger hai, ye 3 saal mein 10 guna, 5 guna ho jayega. But the statistics doesn't suggest that over the last 25, 30 years, and that's across cycles. Sector tilt is normally domestic. Domestic companies, domestic-facing companies create far more wealth. High promoter holding, normally I have seen average promoter holdings above 55%, generally a higher skin in the game creates far more wealth and inexpensive valuations to start off with. The next is, I think this is all about, talking about the stock picking, what not to do, portfolio construction, the forensic part. But I think the biggest friend and enemy in this market, friends, is nobody but you yourself. And I believe that the most important quality of an investor is temperament and not intellect. This is normally happen, and we believe that EQ is more important than IQ. Emotion quotient is more important than intellect quotient. And times like this, your real emotion quotient will be tested out, friends. Be prepared for it. If the next 6-12 months is going to be tough for the markets, your research, your deep conviction, and your own temperament will make a difference, whether you survive this cycle and move on to the next cycle or not. Many a times we see when the momentum is there, everybody is an equity investor. And when momentum goes against you, your temperament kills you because you are not made for equity. So always ask your question that if there's a 10-20% fall, my stocks fall by 30 to 40%. Am I going to buy more of this company or not? Or how will I behave? And I think that answer will define you what kind of an investor you are. Don't be the next Zeds, whether it be Warren Buffett, I want to be this, I want to be that, I want to be all the stalwarts of the market. Understand your positioning, understand yourself, know your strengths, and redefine what you stand for. Be original. Market sizes, seasonality, boom bursts, life cycles are all part like a nature. No company is in a growth mode forever, friends. Understanding that basic nuances is very, very important in stock market investing. Otherwise, if you consider any company in a growth, you will make mistake. I have seen that the biggest multibagger which became for me, a company which started with 300 crores of market cap, today is 1,10,000 crore of market cap. It was never a linear journey, friends. They had years, for 2 years, 3 years, they didn't do anything. Profits stagnated. But the intent of management was right, they worked hard and made sure that they come back. But during that 2-3 year phase, आज hindsight में बहुत easy लगता है कि वो multibagger था. But hold करना उस समय is the most difficult part. And most companies which have become wealth creators had fall of 50-60% during crisis, right? What redefined you was your holding power. And understanding the fact that no company is in a linear phase forever. There will be cycles. And if you are able to pass through that cycle, which is not a great phase, probably the wealth creation will happen. And that's upon you to decide. I think what's important is trust and integrity, friends. We all are participants of this society. And one thing which very sharply comes is the ethics. But I have very closely washed it out. In my 22 years, there were many instances, situations, which were very tempting to make money. However, one thing which I always believed, that Hiroshima was destroyed in a day, but Rome was built over decades. Trust, integrity is very easy to slip upon on, but very difficult to build. And friends, I'm so fortunate that over the last 22 years, when I was managing at Kotak and Principal, and then I started IKIGAI, this one thing of integrity and trust helped me scale where I am today in the last 5 months. Almost touching 2,800, 3,000 crores is because never diluted that core part. And that is the core of IKIGAI as well, trust, process, performance. The reason I am saying so, it's a very important intangible. You won't see it, but markets know it. And everybody thinks market is large, but market is a very, very small animal. आज आप क्या कर रहे हो उसको next वाले को आप सोचोगे नहीं पता, उसको पहले पता है. So the moment you start, diluting your trust and integrity, your cycle in the market will become smaller and smaller. And there was a very nice article in Mint just a week back. And it showed the pyramid of managers and their longevity and people who are managing public money today. So between 1 to 3 years, there were about 1,600 managers in the country, 1,600. And when you came down to plus 15 years active management of money, it was only 24. And then 20 years plus, it was just 10 or 12. So friends, it's not about creating and identifying the next multibagger. It's identifying, staying true to your principles, philosophy over longer periods of time and giving longevity to what you are doing. And trust me, this is a very, very important thing that over a period, if you lose your trust and reputation, you will pay a price over a period of time. Intentionally calls going wrong, there's no issue. Market understands that. Out of 10, 2 calls, 3 calls will go wrong. Otherwise, you are GOD or a liar. But the trust and integrity is something which is upon you. You can control. And if you slip on that, not today, maybe after a few years, you will pay a price for it. So be careful on that. Stay main focused. I think a lot of noise is there. Every year, every day, we are bombarded with so much of noise. How to stay calm, cool, I think is the most important part. And that also comes to the softer qualitative part of individual. How do you do that? I think this is something which I have been practicing over the last 2 decades, friends. And if one thing which I would suggest all of you in this room to do that is meditate, at least for 30-45 minutes a day. If one thing you want to take away from this entire session is, give time to yourself. I think if you have a clear mind, a lot of things will become easy for you in investing world. We don't pay a lot of credence to that, but a view of equanimity is very, very important. Don't forget, this is a lonely game. During times of bad performance, when you're going down, nobody is going to come and support you. Very few people will be there to support you, provided you give them respect when you are at the top. So never get too excited. When you are at the top, when you are making money, be as humble and be, as grounded as possible. The hubris should not be there. And practice meditation, vipassana, whatever you can do. And the best of the investors I know in India, and especially Nimesh Bhai, Vallabh Bhai, Kuntal Bhai knows them very, very closely. They are all great practitioners of this. And look at the kind of wealth they have created. It's not disclosed, but they will be among the most wealthiest persons in India today in the stock markets. And one thing which keeps them very, very good is meditation, sadhana, vipassana. And I think it's something if you can do, practice, you will make a huge difference to yourself and your stock picking. Last but not the least, this is a live example, and I couldn't stay talking about it, the fiduciary responsibility which we carry. Many of you may be managing your own money, so you're not liable, responsible to answer anybody. But when you are managing public money, you are in the eye of public. It's very important you understand your fiduciary responsibility also. This letter, which was 22, in 2022, I thought somebody is playing a prank on me, had a goosebump. This boy has written a handwritten letter to me. I am 10 years old and I study in this and this school in Abu Dhabi, in grade 6. My father has put 1 lakh rupee investment in your Kotak small cap fund. The 1 lakh is my sister's and my whole life saving that we have received from our parents and relatives. Shadi, Diwali, Holi, whatever money you get, right? I hope you take good care of it so that it can help me pay off my college fees. So he's putting an element of trust and responsibility that, Mr. Pankaj, please manage it carefully, hard-earned saving, मेरे को college fee pays करना है इसके साथ. I'm sure you will sense you are one of the best fund managers. Again, a responsibility is putting on you. My 1 lakh is under my father's folio number, this and this. I initially thought when I opened my laptop, somebody is playing a prank. I called my back office. I said, ये folio number है क्या? बोला, yes sir है. मैं बोला, नाम क्या है? बोला, ये है. मैं बोला, कहाँ से है? बोला, सर, अबू धाबी से है. Then I understood this is a genuine case and not somebody who's playing a prank. Friends, I had goosebumps for many, many nights. It played on my mind that when you are managing large pools of capital, generally 1 lakh, 2 lakh inflow, outflow doesn't matter. You will not pay too much of attention. But look at a person who is reposing faith on you, a grade 6 kid. He's saying my entire life saving is on you. And this is the fiduciary responsibility which we all carry on our shoulders. And the day you realize yourself, and as public managers, you will conduct yourself in a better way. And this is something which keeps me awake at night. It keeps me making sure I make less mistakes. Even if I give 2% lower return in a rising bull market, it's fine. But in a falling market, if I can protect the capital, it's also money earned. So I think over this period, what I have learned is there is an art and science to your stock selection process. You should be true to your philosophy. There will be many things which will be suited to different people. That suits me. Your own temperament, that's a softer part, qualitative part, and realization, if you are managing public money, that there is a fiduciary responsibility which lies on your shoulder of millions of investors. If my numbers are right, when I took over the 3 funds, the total investor base was about 70,000. And over a 14-year period which I spent, that number from 70,000 became 24 lakhs. That 24 lakh, 2.4 million investors have given their hard-earned savings for you to manage. Make sure you do not destroy that. That's the only point which keeps me awake, and make sure that we keep on working every day to make our processes foolproof so that it gives us longevity. And if somebody in this room has understood the concept of longevity in equity markets, trust me, they will create a lot of wealth. This is the most underrated spoken topic across the country. People want to make money tomorrow, day after. But once you have a slightly longer term view for your life, for your markets, for your investing, you will look at things very, very differently, and then don't get swayed by the near-term noise which is all around us. So this is what I wanted to share with you on the process philosophy, which has helped me survive in this market. And I hope that if I don't dilute this too much, it will help me survive for the next 20 years and make sure we will make India proud again. Thank you so much.
All right. So I'm sure all of you will agree that last presentation slide was quite heart-touching. As fund managers, we often forget that there are a lot of people who are riding on us, and that was a real jolt to some extent. So thanks for that, Pankaj. I was making some notes while we were saying, and in the very starting, you said easier said than done, right? And when we talk about the processes, most of the time, processes seems like dull, boring, repetitive. यार इसमें क्या मजा आएगा? ये तो सब लोग करते हैं. आप अलग क्या करते हो? And so on and so forth. How do you deal with these kind of constant bombardments of questions around variations in processes? And also, a lot of time there are a lot of dichotomies in the market you hear. For example, I don't time the market is a very common statement made by people. And parallelly, you could say, be greedy when others are fearful, and be fearful when others are greedy. For example, current market. How do you implement those dichotomies into your process, and so on and so forth?
So I think the first point is that all these principles of investing, it's not something new I'm telling you. Yeah. Maybe every part I have taken it a little differently and deeper, which suits my temperament, my philosophy, and added few which works in Indian environment. But these are basic principles which have gone back 100 years. And when you look back to the letters of 1920s, 30s, 40s of many legendary investors, you still find that what was applicable then is applicable today. So market cycles will keep on telling you these are boring stuff. But finally, I believe the basic hygiene of investing is this. If you don't follow it, you will not survive for long. You will make mistakes. And I told you this pyramid. 1,600 fund managers between 1 to 3 years of experience. The moment it comes down to 15, 20 years, very handful. Why? So I think process is extremely important in investing. And the cycle of greed and fear, I think it comes along with experience. Am I expecting everybody in this room to be understanding that? Answer is no. Because look at Mr. Warren Buffett. He has been sitting on cash for last 2.5, 3 years. And he has massively underperformed the markets. And I'll tell you as a live fund manager, the best of the managers get 2.5, 3 years when they are underperforming. We start saying, small kid on the block passing loose comment of that legendary investor. I have come across many meetings when one of the most famous fund manager was undergoing a 3-5 year underperformance. A young kid, 25-year-old, passed a very nasty remark on him. So it's not easy when you take conviction calls that you will always do well. There are phases where you will underperform. That's where your conviction on your process, your own temperaments come very handy. So it's not a one-day phenomena, you learn it. It comes over a cycle. And after that 4-5 year underperformance, when the things worked, he again became a champion, right? So I'm just saying that it's difficult, it's not easy. And we have seen, all of us have experience in this room, that we all go through cycles. And that's why I say, when you are doing well, stay humble and grounded. Because if you are too bubbly at the top, people will hit you when you are bad at the bottom. And a view of equanimity in life is extremely important. That whatever you are seeing good is not permanent. Whatever you are seeing bad is not permanent. It's a cycle. It will mean revert itself.
Okay. While talking about cycles, in fact, very interesting thing happened. While I walked into today's session, somebody said, पंकज साहब से ये पूछना कि जो podcast में कुछ बोला था उन्होंने, I think you recently gave a podcast.
अच्छा.
And you gave some 4 parameters to measure market cycle.
Yeah.
I think you talked about participation of the Nifty 100 companies,
Yes.
the earning yields, and so on and so forth. And somebody just said to me, पंकज साहब से पूछना है जो पिछले 2 हफ्ते में मार्केट गिरी है उसके बाद कुछ ठीक हुआ कि नहीं हुआ? So I'll take your answers.
No, so, in one of the last week Morningstar conference, Madhubhai was moderating it. And the first thing he said, पंकज मैं जब भी आपको कहीं टीवी पर देखता हूँ तो मंदी दिखती है. मैं बोला ऐसा नहीं है. So I said कि we have to be honest to ourselves and to the investors at large. What I was saying was that earnings growth is slowing down, friends. Last 5 years, we compounded at 22-24%, market as an aggregate. Probably next 2-3 years, earnings will be maybe 11-13%. Markets will take cognizance of that. Style shift has started to happen in whatever limited understanding I have of markets. Different factors work at different point of time in cycles. You have to recognize that as a fund manager. Last 3 years was all about momentum, high beta, value when interest rates were going up. It's now all about quality, low volatility, and growth. And companies which will offer that 15-20% growth will again become darlings of the market. And the breadth of the rally will become narrower and narrower. And I still hold that the next 12 to 18, 24 months, friends, will not be easy. गधे घोड़े सब चले last 3 साल में. Now, गधे घोड़े के बीच में separation होगा, and you will see very few companies over the next 12 to 18 months doing well, provided they deliver on their earnings expectation. So I don't think it will be an easy market for all of us. We have to brace ourselves, and as Sunil Bhai said, moderate your return expectation. Wherever I go, I think, paisa to bani jayega. I think people have not seen a phase where 2 years, 3 years in a row, you don't make money. Markets consolidate. I think if that comes to light, how people will react to it is my worry. And I think I'm seeing that. Earnings growth slowing down, market rallying narrowing down, handful of companies outperforming, and that's my belief.
I think
that will happen.
That fear is visible in the questions also, right? So some of the questions are, ask Pankaj how he manages the risk in his portfolio at this point in time. So in the current markets, how do you manage that risk? And do you do any kind of options to hedge your portfolio, any tail risk hedging, et cetera, et cetera? So maybe overall your perspective on how to look at risk, especially in these kind of markets, and how do you position your portfolio around that?
Okay. So I think, as I said, portfolio construction is the tool which helps me manage my risk at the portfolio level. And my endeavor is that जब market गिरेगा, everybody will fall. But I should be the last man standing. And I should fall much less than what the market fall is. And that can only happen, friends, on the quality of your companies and your portfolio construction. I have seen in 2008-9, 2013-14, 2020, prior to that, that in a bad cycle, companies which have defied basics in terms of return on capital, leverage on the balance sheets, gets beaten out. एक cycle आती है, वो जो weed है वो निकल जाता है. And I think that's where your real expertise comes in. And I think whatever I spoke about in stock selection is the most important tool which helps you in a bear market. Promoters, business, quality of business, balance sheet, cash flows. ये basics है, friends, इसको मत defy करो. The reason again and again I am repeating this is you may find it boring, but when I look around the market today, stories and stories and stories and stories are going on. You speak to companies, and a classic test देता हूँ. Every day companies come for IPO. आप उनके presentation को फटाफट देख लो before they have sat down, you have said, shared greetings. एक presentation को just flip out कर लो. अगर उसकी cash flow खराब है, वो presentation का part ही नहीं रहता है. अगर उसका presentation में cash flow है, इसका मतलब the company is a well-run company. And then you have to ask the banker and the company, what is your cash flows? 80 out of 100, if it's bad, the management will not know also. And companies which came today, last week, one Hyderabad company came, sub story, पूरी, ये cash flow, ये profit यहाँ से यहाँ हो जाएगा, ये यहाँ से हो जाएगा. मैं बोला, sir, what has been the cash flow of the last 3 years? Operating cash flow negative. मैं बोला, how is it possible? We are a growing company. बोला growth without cash flows. बोला doesn't matter, no. I'll keep on diluting whenever I need money. Immediately you know that this is not the management to bet on. So over a period of time, friends, this is basics which you should not defy. And the price which you are paying is absolutely important. I didn't touch upon it. There are cycles. There are companies which are great companies. But if you buy at a wrong price, I think God save you. And time correction can be very, very large.
Okay, Pankaj, we talk about processes, and processes seems to give impression that everything is black and white, right? Majority of the time when we are operating in the markets, we are basically operating in a very gray zone. For example, you talked about your MVB framework. Most often than not, you will not find all the three coming together for a perfect pitch. Also, within companies also, we have cases where one segment you see very good capital allocation being done by the company, good business, but parallelly also other segments which are laggards and maybe heavily capital allocated, maybe less capital allocated. These kind of gray areas when you are evaluating the companies, how do you deal with this? And as an active manager, can you act on it from a persuasion angle to the management and change the course of the companies also?
So not everything will be a tick mark when you are evaluating. There will be shades of gray. There will be things which you will ignore. But you have to give importance to every parameter, and at that point, which parameter you are most important. For example, unlikely I will dilute on management quality. Because businesses will go through up and down, but management is something which is constant. And time and again I have seen that wherever I have made that mistake, it's been brutal. So one thing which I have learned that I will not bet a chor bane more promoter. Many companies, they have demonstrated in the past, they have not been fair to the shareholders. People think they are changing, they give them the benefit of doubt. I am not of that camp, personally.
Any example you would care to share where you lost the money because of bad management?
Many.
Oh, okay.
Many. So many of those calls which of commission have gone wrong is wrong reading of the management.
Okay.
So I think that's something which I will never change. Apart from that, one more learning which I had is that a lot of time we, in growth companies, we look at valuation. Everything else being constant, we look at valuation and say high P, sell it off. My learning is that many a times that 50 P is cheaper than a 15 P. And time and again it's proved in financials, for example. People have been buying the low P stocks in banking, saying it's the next SDFC or the next Kotak or the next XYZ. And finally you saw that over the last 5-10 years, one bad cycle, you know who is SDFC, who is Kotak. So I think this comes by learning over a period of time that growth, even if it is a slightly premium price, pay for it. Because many a times mistakes which I have made is I have sold off very early, considering the valuations have become expensive. And from there, the company kept on delivering growth and valuations and price became 10x of where I sold. So not only errors of commission are important, errors of omission are equally important. And a large part of my errors lie in this second bracket of error of omission. Because there the multiple where from you sold can be 10x, 20x, 30x, 50x. Many companies I just feel regret about that I sold on very, very early at maybe 20,000 crore market cap, 30,000 market cap. And from there it has become 3 lakh, 4 lakh, 5 lakh crore market cap. And one thing which I have learned is growth is the horse, valuation is the cart, not the other way around. If the growth continues to be delivered, valuation will sustain itself over a period of time. The moment growth falters, valuation also derates. So your eye should be on growth, not too much on valuation. Yes, valuations are important, but that's my learning over the last 2 decades, that keep following or keep monitoring growth very carefully.
Okay. Another question which we keep on often hearing is the edge of an active investor. Okay, so most often we talk about, and the classic example comes of US markets, where the active fund managers are not able to beat the market for a long period of time. And a very common question is, why is it that in India, an active fund manager has an edge in beating the indices? Especially Sunilji gave those data points, right? That index themselves can be multi-baggers. Then why go to active fund manager and why not go passive way? So the question I'm trying to come to is, as an active manager, what edge you think you bring over a simple strategy of, let's say, buying passively a fund?
So I'll give you this very important data point, at least for India. Okay.
India, okay.
So with this entire analysis, the first I'll tell you the conclusion. The conclusion is that alpha is cyclical. Okay.
Sure.
If alpha is cyclical, the outperformance and underperformance of active managers is also cyclical.
Sure.
If you remember 18-19, everybody in the market was complaining that active management is dead for large caps. Okay? Because Ritik was moving. And nobody had that 10% Reliance, 10% SDFC, and so on and so forth. Then you saw the last 3-year rally, where equal weighted index would have done far better than a weighted index. Right?
Yes.
And then you saw most of the large cap managers outperforming the index. Now nobody talks about it. So it's a cyclical process, right? It's not permanent. Till 2022, all mid and small cap managers were outperforming the index massively. 8, 10, my fund was outperforming 10 to 12, 15%. Last 2-3 years, most of the managers underperformed the index because beta ran up, the bulk of one industrial group stocks ran up. No, most of them were not participant.
Yeah.
So first, I think it's a myth that on a rolling return basis, everybody is underperforming. It's not the case, friends. If you do a 3, 5, 10-year rolling analysis of across categories, mid and small cap managers have outperformed the index massively over a 5-10 year. We only look at some of the categories and say that active management is dead. That's not the case. And I believe that please understand that reality, please. Otherwise, this question will keep on coming that active managers to bekar hai. मेरे सामने राजीव भाई बैठे हैं. Would you all agree Rajiv has done a good job or not? 80% लोग हाँ नहीं बोल रहे हैं. हाँ या ना? Has he outperformed the index or not? Is active management dead? No. Classic hai. So I'm just saying it's a myth which has come across over a period. I have managed the mid and small cap fund. Top 100 stocks is researched by at least 24 analysts on the street today. I'm giving you hardcore numbers. The moment you become from 101 to 400, that number from 2430 on an average drops to 5 to 8. That's where your edge is. If you can deep dive, do your deep research on companies from 101 to 400, 500, and if you can spot few of them which becomes larger in size, your job is done as an active man. And that's what we try every day. So my sense is it is a cyclical process. Alpha is cyclical, process is permanent, and active management, at least for the next decade in India, is not dead, friends. Your effort should be to find out managers who can survive cycle, understand risk, understand cycles. You should be fine. Don't worry about it.
All right.
I don't know.
Since we are short on time, I'll have to take...
Rajiv bhai, batting ठीक किया क्या active वाला के लिए? But this is what my thought is, that active management is going to be there in India at least for the next decade, because the plethora of companies which I am seeing at the ground level is making me excited about it.
No, I fully agree. So I'll take 2 participant questions which could be a good end to the whole thing. First, you mentioned AI technology used nowadays in your investment process. Right?
Yes.
So can you expand a bit more on those tools? And along with that, at the just end, give your top 5 best picks for books. So some of the participants are saying, give us the books picks and not the stock picks.
Okay. So I think what we are doing at IKIGAI, for example, or I was doing at Kotak. So I think we all discount the power of technology right now in our investment process. I'll give you a few things. So we all track consumer companies, consumer durable companies, and we all are dependent upon, say, distributor channel checks, stuff like that. what we have built in our process is through a AI, that for every company, the product reviews, and the Google reviews are very powerful, trust me, that will pull off, and similar kind of products available by other companies, it will do a analysis for you. What it helps us, that when we are meeting the company, everybody talks good about themselves. Nobody will talk, my products are doing bad. And certain categories where they are weak, you can have pointed questions because you have data in front of you. Recently, we sent one of the reviews of few products of a company to the management, and they were shocked. The CEO didn't know that the Google reviews were so bad. And now they have incorporated that as a part of their process. That's one thing which I'm talking about. Second, through ChatGPT, friends, you can do a lot of things which are wonders. For example, the management I talked about. How do you go into the past? How do you do a lot of scanning of data and stuff? I think AI we have incorporated, which helps us do that. So over a period of time, I think technology is a tool and an aid. And if you use it rightly with an open mind, it can help your research process. And every day we are trying to improvise and see how better in terms of productivity we can do that.
Yeah.
And I'm shocked the amount of things which are there.
Yeah.
And the small boutique outfits which are doing that. If you guys can engage with few of them, trust me, you yourself will be surprised with the kind of advantage you can get in your process.
Yeah, a lot of people I talked to have stopped using Google and started using Perplexity for their searches.
Absolutely.
Yeah,
absolutely.
perfect. And the book picks.
The books, so obviously I said one of my favorites is All I Want to Know Where I'm Going to Die, So I Will Never Go There. The recent book which I read is 10x is greater than, easier than 2x. Then 1-200 Bagger, which is a very, very important book everybody should read. Then 2 books on wisdom of life, Zen of living. I think it's a very short book which have come. And one book which I found really fascinating, I was reading on the flight last night, is the book by Dipender of Zomato. It's a handbook, very small, maybe 20-25 minutes, you can just flip it out. It's called Culture. Culture, right?
Yeah.
It's a red book. It's a handbook which is given to every employee who joins Zomato.
Oh.
When you read that book, you understand why that company is that company. And that's not something which is just an absurd thing. You speak to any Zomato employee, that book is a handy reference book. And one thing which came out very, very interesting in that book is, if you are successful every time what you are doing, you're not fit for Zomato because you're not taking adequate risk and thinking out of box.
True.
So if you're successful in everything you are doing, probably it's not the right employee for you. So that book is a very, very handy book. I just flipped it and amazing. So it's a small one, but talks about how cultures are built in an organization. And friends, today the biggest moat is not technological advantage that can be copied, distributed advantage that can be copied, product advantage that can be copied. But the only thing which can't be copied in an organization by another organization is the culture. And if you can understand the culture of that organization, why people love to come and work with, I think you have got a multi-bagger in making. Because that's something which is, in my view, is the biggest advantage most companies in the world are having. Rest, everything is a commodity.
Okay, perfect. Thanks a lot, Pankaj. I think we've got a signal to move.
Thank you.